Good day, and welcome to Dr. Ransford's Weekly Wraps. I'm Viv Governor. This will be a little different this week. Since we had our AI seminar, which will also be on YouTube, we're not going to have an AI segment to this particular wrap-up. And the second thing is that it's also a very big week for interest rates. We had the first rate cuts from the US and from South Africa. And so I thought it might be worth looking at interest rates, looking at what's going to be happening the next couple of years, what we expect to happen, and what it's going to mean for you and your investments. So that's going to be the main topic today. We'll also just do a brief little wrap up on what's happening politically in South Africa and internationally as well. So let's start with the political stuff, and then we'll do the main segment on interest rates. So politically, in South Africa, we are seeing some tensions emerging in the GNU between the ANC and the DA around things like the basic education amendment, Bella, as well as the NHI, the health initiative. So why is this tension, and what does it mean going forward? Well, the ANC and DA are not compatible politically on a number of issues. In fact, they have several fundamental value differences. And that means that it's not a case of, different approaches to achieve the same outcome. Sometimes it might be they want different outcomes. So, two really motive aspects for any voter is going to be healthcare and the education of their kids. And these bills basically infringe on both of them. The DA has a view about this that's very different from what the ANC does. To give you an idea what the ANC is looking to do, it's looking to basically, with the Bella, to remove restrictions on which schools kids can go to. And with the NHI, basically kind of increased access to healthcare. Sounds very positive in terms of the goals. The difference is, I think, that the DA thinks that the approach that the ANC is doing with regards to healthcare will destroy the healthcare system, and with regards to schooling will destroy the small number of public schools that are good in the country. So this is an area of, I think, contention. Thus far, what's happened is that the more contentious parts of the Bella bill, the education bill, has been delayed for a few months while they kind of hammer things out. But I do think that there needs to be a solution to this, or in the longer term, I don't know how strong the GNU is going to be, and whether it will be able to last the 5 years till the next presidential election or not. Next, looking at the US, we are seeing effectively, despite what polling says one way or the other, it's almost a toss-up. It's like 55-45 one way or the other. That's as good as it gets in terms of the chance of winning the election. In terms of the popular vote, Kamala Harris seems to have a consistent lead over Trump, but that doesn't matter in the US. You can lose the popular vote and still win the election if you win the Electoral College. And right now it does seem that the Electoral College is pretty evenly split. And the chance of either party winning is, either depending on the polling one way or the other. Like I said, 55, maybe 60 to 40. 60-40 sounds like a big difference, but you do 60-40 5 times, and 2 times the 40 is going to win. And that's not a very high odd. So you wouldn't be surprised if 40 wins, quite often. So I would think that in this scenario we are seeing, like I said, toss-up. Going forward, I do think that come the election day, we are going to have a bit of uncertainty. The best outcome would be a win by somebody that's pretty emphatic. The worst outcome would be a loss by somebody that's very contentious. I would hate to think what would be the outcome if we had an Al Gore situation right now. Remember Al Gore back in the day where there were these few hanging chads? Old people know what that means. Basically, they had this punch system that sometimes they punched a hole for voting, and sometimes that hole would actually take the whole piece of paper out. And so people were calling those little things hanging chads, and were you counting those or not? And if you were not, who's going to win? If you were, who's going to win? That's the kind of issue you're talking about here. I think that, like I said, best outcome, strong victory for a president, and their party losing in the Congress and Senate. As unlikely as that's going to be. Because what you really want to have is no uncertainty about the election, but you don't want to have any of these political parties fully in charge of the economy, because both of them are putting forward policies right now that are extremely, badly thought out, be it tariffs, be it massive subsidies, be it a whole bunch of different things that they're thinking about that are probably going to be negative for the U.S. economy and therefore the global economy as well. So you'd prefer if, like, whoever is the presidency doesn't have his party also in power at the Senate and the Congress level to push his agenda through, or her agenda through, rather. Because in both those scenarios, either with Trump or with Harris, I don't think those unified presidency, Senate, and Congress would be good for the world. So now moving on to our big story of the week, which is obviously interest rates. So interest rates basically were cut in South Africa a 0.25% and cut in the US by 0.5%. So let's look at why did we cut by a quarter, why did they cut by half? Well, the US cut by half because they see a target of where they want to get to interest rates. And if they're basically more certain about it, they're pretty confident that they are on the right path, rather than just start big and basically, get you to your target earlier. We South Africa caught by a quarter because we just don't have the flexibility in terms of being able to surprise the market that the US did. The US, decision wasn't a total surprise, but if you look to like a couple of weeks ago, the chance of a 50% rate cut was less than 30%. On the day it occurred, I think it was like 50 something to 40 something in favor of a 50% rate cut. So it was a bit of a uncertain event. In South Africa, we can't afford these uncertain events. Why? Because we have less credibility in the markets, and the market views us differently, obviously, than what they view the US. And so if we start acting in a way that the market thinks is irrational, or not irrational, but erratic or uncertain, they are very quick to penalize us in a way they will not penalize a developed country, especially not the US. The example I always give here is Turkey. Turkey basically is a much larger economy than South Africa, more developed economy than South Africa. There are more people, and those people are wealthier per person than South Africa is, to give you an idea. Yet, when they started messing around with interest rates for political purposes, it caused their currency to collapse. By collapse, I mean devalued by 10 times in less than 10 years. That's like us going from, like, say, 17 some change right now to 170 by 2034. That is what we're talking about. So it's a huge weakening in their currency. And that is because markets don't trust them and therefore penalize them quite badly. In South Africa, we've basically built a bit of trust in the market. Financial markets do trust our institutions, but we don't have it as much power and much gravitas as the US does to do a surprise move most times. And so therefore it kind of makes sense that we have to go more conservatively, even though in actual terms our inflation rate is below our target, the US is not. Our growth rate is very low, our unemployment rate is very high. The US, that's not true. So if you looked at those numbers, you'd say, we have a stronger case for having a bigger cut than they do. And also interest rates are high here than there, so it's easier to cut 0.5% from a high interest rate than from a lower interest rate. All things are true. But again, because of the lack of confidence in the South African market, that's like what they have in the US. I'm not to say that it's justified, but I'm saying that's what the market does do. It means that we just can't take these risks. And so we cut as we cut a quarter. Now, what does it mean going forward? This is the start. We're going to get cuts, multiple cuts this year and going into next. We're probably going to be down, well in excess of 1%, lower interest rates in the US by the end of next year, and similar in South Africa as well. So consistent cutting, no chance of rate hikes unless there's a massive surprise in inflation. The next US meeting is after the US election, which is on the 5th of November. And one of the things that I think may have been some worrying, Jerome Powell didn't obviously affect his decision in the end, was the perception that he was acting politically because cutting interest rates is perceived to be a stimulatory effect. If you do it just for an election, that seems to be the thing that helps the guy in power as opposed to the person trying to challenge them. So it helps Kamala Harris as opposed to Donald Trump. So it could be seen as that. In fact, Trump did mention the fact that he thinks that this is a ploy to help Harris with the election. But irrespective of that, I think that rate cuts, foreseeable future, going through no problem. One little exception here we saw recently was the UK, which didn't have a rate cut because they saw core inflation rise a little bit. And I think that is obviously something to be concerned about. Inflation is obviously, a thing of perceptions, a thing that can build up momentum. And if core inflation is staying sticky, then we are going to be seeing, rate cuts like this probably backfire, because what happens is inflation is still around. You start cutting interest rates, you kind of build that inflation into the system, and once inflation is built into the system, it becomes very difficult to get it out. And now that comes to the next part of what we're going to talk about here, is how does this inflation stuff, interest rate stuff work? I've talked about this before, but I just think it's worth putting again. The way inflation turns in from a once-off increase in oil or eggs or whatever it may be into a consistent, extra couple percent a year in price increases is via wages. What happens is there's a surprise increase in the price of eggs or oil or whatever, and suddenly you find that it's more difficult to buy stuff in the shop for the same amount of money. Then you go to your employer or whatever it may be, and you ask for wage increases. Your employer sees this stuff happening and basically starts planning for price increases on these things, because he's obviously going to have higher costs. And if you do that for a few years, workers get used to certain wage increases. Employers, businesses get used to certain price increases, and they start building it into the system. So even though there was initial increase in terms of certain commodity, you could find the oil price going from, say, 100 to 200. Everybody sees high inflation, everybody demands high interest rates, higher wages. That makes prices go up. But if the oil price falls from, say, 200 back to 100, people are not going to give back those wage increases. People are not going to reverse those price increases. And so those wage and price increases become embedded. And what happens is, over time, is people get used to certain patterns. A pattern they get used to is like expecting a wage increase, expecting a price increase. And these expected increases, is what you really want to try to fight at as a central bank. You want to make sure that these expected increases are at your target. In the US, it's 2%, and South Africa is between 3 and 6. Effectively, it's 4.5% in South Africa. And if you see inflation, rising more than that, you see wage increases rising more than, say, 4.5%, 5%. You see basically because these normal, regular increases being in excess of inflation, you're pretty certain that over time your inflation target's going to be basically messed up. And how do you fight that? So what you do then is you try to slow the economy down. You try to reduce the power of businesses and labor when it comes to negotiating prices. So labor basically has a higher unemployment rate. Therefore, they can't be as firm with their bosses about asking for higher wages. If there's less demand in the economy, businesses can't raise prices because consumers will be not buying their stuff because they have choices. And that's how they effectively go off and look at curbing or cutting inflation. It's by reducing demand, increasing unemployment. That's what interest rates hikes do. Now, getting back to what we were talking about. If you're going to be cutting interest rates going forward, the reverse is going to be happening. You're going to be seeing a tighter labor market because there's more people going to have jobs. And the second thing is you're going to see more people buying stuff because more people have money. They have, the ability to borrow money. They have less money they're spending on paying interest. All those things. Now, in that scenario, what are we going to be seeing going forward? I think that we are likely to see wage inflation probably be more of a problem than people think. I think that over the last couple of years, we have seen wage inflation just really start to catch up with some of the inflation we've seen in the past. So wages have just started to catch up with the price increases they saw in the market, etc. But I think that as we go forward, we are going to be seeing the wage increases remaining pretty strong, especially driven by things like government workers, etc. And then at the same time, I think that certain commodities are going to have some price support going forward. I mean, oil has come down dramatically, but that market is still very vulnerable to disruptions from things like Iran and Israel, etc. So I do still think that there's still some issues with oil. I think there's issues with copper and some other raw commodities as well. I think there's issues as well with some forms of soft commodities as well. So inflation is likely not to go away entirely. And then when we are in the rate cutting cycle, hitting into this, I think we might just see a bit of an uptick in inflation again. And it remains to be seen what the reserve banks are going to do. Are they going to pause? Are they going to basically reverse? It's going to be a hell of a thing to reverse. That'll be a real admission of fault. So yeah, that is one thing. And then on a macro picture, a bigger long-term picture, there's something I want to point out that is a bit more conspiratorial, but it's really been reflected in history. We are at the point where we have unsustainable debt levels in much of the world. The US now is spending more per year on servicing its debt, that means paying the interest on its debt, than it does for its military. And the military is one of the biggest expenditures it has. We are seeing rising budget deficits globally, rising debt to GDP ratios globally. Europe, Japan, even China, the US, all of them have problems. At the same time, we're hitting a bad situation with demographics. There's too many old people, not enough young people. When they started all these welfare programs in Europe and the US and Japan and so on, you had like over 10 times more young people working than you had people that were retired. Now that ratio is not anywhere close to that. It's like under 5 in some places. You can't have a situation in which the same benefits are provided by 10 people to 1 and have them now to say 3 people to 1. It doesn't work. 10 people, you can take, say, 10% of the wages and support the one person. It's not going to be too difficult. With 3 people, you can take a third of their wages to support the one person. That becomes a whole different story. And I think this demographic issue, plus the rising budget deficits we are seeing, plus the massive amounts of debt we are seeing, means there's only 2 solutions to this problem. One, either the economy grows really, really fast and overcomes this issue with regards to debt, or you inflate your way out of it. What do I mean by that? You let the value of money fall, then before the value of the debt falls, and therefore you are able to basically reduce that debt burden you have as a country. Now, it's possible we can have growth. I mean, AI, I'm favorable about that, and I've seen indications that we will see AI improvements in productivity come through in the next couple of years, and that could be enough. But if it's not, then you would expect that governments, wouldn't explicitly say this, but they would kind of, want it to happen, would not mind a bit of inflation. Why? Because it's going to reduce the debt burden that they have, and therefore make it easier for them to basically function budgetarily. And I think that's another issue we need to look at long term, is the fact that inflation is not gone. It's probably not going to be gone for very long, and there's actually an incentive for it not to be gone. It's not just this is a problem, this is a problem that other people might want. And that is a very hard problem to solve. Okay, that's it for this week. Thanks for having me. I look forward to speaking again next week. We will go back to the normal format. Cheers.